Hey, Bulls and Bears, welcome back to another dose of economic reality. We've got a lot of good news to get into today, and let's start right here. This is the commercial real estate meltdown. Financial Times, U.S. banks prepare for losses and rush for commercial property expert. A lot of these banks that are sitting on these assets, these loans, basically, they have to make a choice. Do they want to sell these loans at a discount? Because who's going to buy these loans at full price, knowing the turmoil that's happening right now? How many vacancies we have in commercial real estate? And this goes back to the whole work at home thing, which a lot of companies kept it permanent. And some companies, look at Amazon, the employees are fighting and protesting, having to go back to the office. And we've seen commercial property prices plunge in some cities as much as 50%. Look at San Francisco. And this is only going to continue. But behind the scenes, we have the banks trying to figure out what to do now that this is melting down. Remember, back in the 2008 housing bust, it started with residential real estate and the subprime mortgages. Now, it's looking like it's going to be commercial real estate that kind of leads the way as far as the housing bust. And this has broad impacts on the economy, and it takes a while. We saw this meltdown happening starting a couple years ago, 2020 health crisis and beyond, with the whole work at home thing. It takes a long time for it takes a long time for some of these things to play out, doesn't it? So this article here talks about how these banks, one, are pulling back on lending, but two, are grappling with either selling off these loans at a huge discount, because who's going to buy up these loans not knowing if they're going to be paid, right? So whoever buys these loans is going to be buying it with the hopes that the borrowers pay back these loans at the agreed interest rate. If not, they could even buy these at a discount and still end up losing a lot of money. So very interesting. We're going to have to keep an eye on that commercial real estate bust. Remember, last report, we talked about how Elon Musk is out there basically calling a commercial property crash, which is happening. Prices are dropping very rapidly, but he says that's going to be the first shoe. The second shoe is going to be residential real estate. And with some of the news we have coming up here in just a few minutes, I think you'll agree that residential real estate has nowhere to go but down. But there's some surprising numbers we want to talk about. Now, first, before we get into the news, though, quick word from our sponsor. One of the themes of this channel is real money. A lot of people don't have much on the side to invest because of the cost of living, but a lot of people have retirement accounts. So take a listen here to our sponsor. And on the other side, we'll get back to more financial / economic news. Reign in wealth like King Charles with a gold IRA from Noble Gold Investments. Just as King Charles's magnificent gold crown symbolizes wealth and power, a gold IRA can fortify your own financial kingdom. Imagine the confidence that comes from a retirement backed by a tangible, proven asset, gold. An asset that's not at the mercy of unpredictable market swings. A gold crown may not be included, but isn't a future free of financial stress a worthy throne? Like royalty, enjoy the luxury of choice. Gold, silver, platinum, or palladium, the realm is yours to command. Fend off concerns about economic downturns and let your wealth thrive with the timeless security of precious metals. This month, the first solid quarter-ounce gold standard bullion coin ever issued with King Charles III's image can be yours with your own qualifying gold IRA or 401k rollover of $50,000 or higher. You can't go wrong with Noble Gold Investments. Call Noble Gold Investments at 877-646-5347 to get started, or visit bullboomgold.com. That is bullboomgold.com. Link down in the description of this video. All right, next, with the banks and the banking crisis, after the turmoil in regional banks, here comes new regulation. And what's being discussed here is a 20% boost in capital requirements. So meaning banks have to hold back at least 20% of capital compared to how many loans they give out. Do you guys know what the ratio is now? 0%. How crazy is it that regulators let this happen, and now we have these bubbles that are bursting? It's like we have the biggest idiots running running the regulations, making the regulations rather. Biggest U.S. banks could see a 20% boost in capital requirements. Originally reported out of the Wall Street Journal, banks with trading businesses or that are dependent on fees could take the biggest hits. It's likely going to be the big mega banks. Remember, though, the mega banks saw a lot of deposit inflows, people that were scared to keep their money in the smaller and local and regional banks. So they're going to be the best able or in best position to bump up this capital requirement. Also, having to have 20% in reserves could really force these banks to give out more for people depositing money, because if they have to have so much in deposits or in reserves, then they're more likely to give out more to entice people to put their money in the bank. And we're seeing some online accounts right now, online savings accounts, giving out 5% annual percentage yields for savers into those accounts. So it could go up even more if these capital requirements are implemented. Let's step back and look at the big picture on this and think about this. If this would have been in place the whole time, they wouldn't have been able to loan out so much money. The cost of living would be much lower. Home prices would be much lower. How much lower would home prices be right now if banks were held to the standard the whole time? They cut it to 0%. How insane is that? And they thought that somehow bubbles would not form once again. And now we see these bubbles deflated, but yet the experts are surprised, that all this is happening. It's just insane. I mean, we saw this coming years ago. U.S. core factory orders unexpectedly shrank in April, the weakest since the 2020 health crisis. There's that word again, unexpected. Who is it unexpected to? Isn't it amazing how all the experts that are on these talk shows, all these business news shows, that get on there with their suits and their ties, how they're always surprised and how their forecasts are always wrong. Isn't that interesting? Not all of them, but a lot of them. The headline factory orders rose just 0.4% month over month, half of the 0.8% month over month expected, and the March data was revised from 0.9% to 0.6% month over month. This left the annual growth in new orders at 0.2%, the weakest since October 2020. Folks, we have to talk about this. The unemployment number, I know a lot of you already know this, but let's take a look at a chart with this one. 3.7% is the official unemployment number. That's as of last month, as of May, 3.7%. We saw it over the past year get as low as 3.4%. That was just last month, or the month before last month, rather, April. I keep forgetting it's June already. Almost halfway through the year. Wow. 3.4% in April. We're up to 3.7% now. But take a look at this. Take a look at the number of people not in the labor force. Let me put up the chart right here. And this is a 5-year chart. I want you to look to the left side of the chart first. That's pre-health crisis. Then, of course, you see the big spike in 2020, early 2020. Then it came down later in 2020. But look at that. We haven't gotten down to pre-health crisis levels, to where it is on the left side of the chart. We haven't gotten back to that as far as the number of people not in the labor force, right? Where is the recovery? But yet they're telling us that 3.7% unemployment rate, which is still close to 50-year lows, is the real number, folks. This chart debunks that right here. All you have to do is look at the Fed's data here to get this. But yet the BLS, Bureau of Labor Statistics, is telling us it's 3.7%. I think a lot of you know the scam that's behind that number. All the people that aren't qualified for unemployment now are no longer counted as unemployed. So I always have to bring that back every couple months, just so people don't forget how much of a scam and how manipulated and how phony these economic numbers are. And maybe that's why so many of the quote-unquote experts keep getting it wrong. And every time you see one of these bad news reports, bad data come out, they say unexpected, unexpected, unexpected. Are that many economists or business people in the business world, are they really looking at this data thinking that this is the real deal? The unemployment numbers and much more, pretty much every number that's come out of the official reporting is phony. And I wouldn't be surprised if the not in the labor force chart is probably much worse than they're projecting right here. But even if you take it at face value, it's pretty bad. It shows things haven't recovered to pre-health crisis levels. Right. Recent headline here out of Z Hedge: the great student loan non-payment boondoggle is over. Household spending is about to collapse, folks. You thought job losses were happening now. You thought layoffs were happening now. How much less spending power are students going to have, or people with student loans going to have, now that they're going to have to repay these student loans? And the average student loan monthly payment's about $400, folks. How many of these people that are going to have to repay their student loans are going to now get further behind on their car payment, further behind on their rent? This is going to be a very big situation to keep an eye on here. And things are already crumbling even before this, and now student loan payments resuming. We'll have to keep an eye on that, but it doesn't look very good at all for these students. Apple launches its $3,499 virtual reality headset. Wow, what kind of people are going to be spending $3,500 to get virtual reality? I guess all the people living paycheck to paycheck, they can live in an alternate universe and pretend that they're not buried in debt under these goggles. But that's what it says here. $3,499. What a bargain, right? The mortgage payment needed to buy a median-priced home for sale in the United States has now moved up to $2,651, a new all-time high. Folks, what was probably the only channel here telling you that homes are not going to get more affordable? First of all, the health crisis, I was one of the only ones saying the housing market was not going to crash. To me, that was obvious back then. The average mortgage now, $2,651, is higher than last year, where it was about $2,370. So we're up, according to this, 15% year over year. Pretty amazing. Back in 2020, before the health crisis, we were just under $1,500. Wow. So this is an amazing housing bubble. Even with interest rates, even with mortgage rates rather doubling from where they were, we're still seeing this price rise as far as the cost. Now, home prices are coming down in most areas, not in all areas, but in most areas, and the overall average median price is coming down. But this is pretty amazing, and we're not seeing the surge in inventory yet. Will we see it later this year? Please let me know what you think down in comments. There's people out there saying this housing bubble is never going to bust. But to me, there's just too many things happening. And I still am calling by the end of the year, we're going to see home prices fall much harder and faster than we've seen thus far. But remember, last month we had a bunch of news articles out there saying how the housing market has bottomed. And what I said at that time is they're trying to sucker people in before the plunge really gets noticeable in home prices. And that's typically what they try to do at the peak. Even when home prices start coming down, they try to pretend that it was just a temporary dip, and they try to sucker people into the market. We saw here in California, we had this first-time home buyer incentive, and we're going to keep an eye on that. But real estate's definitely an interesting part of the economy here that we have to look at. And if I could give a word out there of, I don't want to say advice because I don't give financial advice, but I would encourage you to take a look at detaching from this system. We have the debt ceiling increase once again. That supposedly staved off an economic collapse, and that's what some of the people are out there saying. They're trying to take credit for prolonging, or they say that they avoided the economic collapse by increasing the debt ceiling. I'm going to maybe get my family together, and we're going to have a vote, and we're going to vote on increasing our credit card limit. I'm going to call the credit card company. I'm going to say, hey, I just had a vote with my family, and we all decided that we need to increase the debt ceiling. What do you think the credit card company is going to say to us if I said that to them? But yet that's what we do as a country. We have this vote, and we say, oh, we're going to raise the debt ceiling. Who's this money issued from? Who do we owe this money to? The 32 plus trillion dollars in debt. Who do we owe that to? Folks, this is fake money creation. They're clicking a mouse, trillions of dollars at the click of a mouse, more money than you and I will ever make in our lifetimes at the click of a mouse for them. The whole thing is a joke. It's a scam. You've got to position yourself against it. The thing I'm doing is still precious metals, especially silver. I'm going to have something coming up in my next report about that, as far as getting some extra money in your pocket here. For now, we're going to wrap it up here. I've got a video that popped up in my feed, though. The headline was pretty interesting. Greg Manarino, recession coming? No. How about a super depression? Folks, it's going to get bad. People right now today are in a much worse position than they were back in the Great Depression. Back then, more people were self-sufficient. They could grow their own food. They were more. They had more real-life skills. They could barter out in the community with things that they made or built or grew. Now, not so much. People are stuck. Working for the digital coins, so to speak. And you can't eat coins, so I always say stack food as well, and be ready, because things could snap. And this whole thing, we could wake up one morning, this whole thing could be imploded. There's so much derivative debt out there. One missed button push, one missed trade at a high level, can bring this whole thing crashing down. One grid outage, one system compromise could bring this whole scheme down in a flash. So be ready for that. Otherwise, continue the grind, and we're going to watch this play out, and we'll be on top of it here for you. Please come back for more economic financial news. Thanks, everybody, for being here. Keep stacking. Bye for now. Peace.